Well, the new tax bill does not fulfill President Trump's promise of no tax on Social Security, but there is a benefit for seniors and a new deduction. The Senate bill has a $6,000 deduction for those 65 and older. I'm going to go over how that works. The House bill that already passed has a $4,000 deduction. Now, I want to go over how these deductions work. Those who are 65 and older already get an additional deduction that's already in the tax code now. This is going to layer on top of it. Trump could not get through no tax on Social Security, so this is what we have. And then later in the video, I want to go over strategies that those of you who are 65 and older can take on your tax return that will save you money, whether this bill passes or not. I'm Matt Sorensen. Let's build wealth. All right, now the House already passed this. This is a $4,000 deduction. This goes in addition to your standard deduction. You actually don't have to take the standard deduction. You still get this. So even if you itemize, you could take this $4,000. Now, if you are two individuals, a married couple filing joint, and you're both over age 65, that would be $8,000. All right, now the Senate bill upped the ante on this and increased this to $6,000 per person, again, age 65 or older. Now, the Senate bill is still being negotiated, but the president, the Republican Party have said they want to have this bill done by the 4th of July. We'll see whether that happens. The House goal was to get their bill passed by Memorial Day. Everyone thought they were crazy, and they actually did it by a 1-vote margin, but they got it done. So we'll see if the Senate can get together on this. Now, if both these bills pass, they're gonna have to go into reconciliation and figure this out. If we got 4,000 versus 6, President Trump can only sign one bill. What we have right now is a deduction, okay? This is not a tax credit. This is a deduction that lowers your taxable income. I'm gonna go through a specific scenario here to see how this will affect you and how it will save taxes. We're gonna go over a specific example, but this is not no tax on Social Security. That was what was promised on the campaign trail, and Trump could not get it done. Now, keep in mind what's in the tax code now as to taxation of Social Security is already a limited structure. So if Social Security is not fully taxed already, the maximum amount of Social Security you can have taxed is 85% of your Social Security income. And that's if you make more than $44,000 a year. That's your combined income if you're married filing joint. Single, $34,000 or more. And already in the tax codes, for those who are lower income, those that make less than $25,000 a year single or $32,000 a year married, they don't pay taxes of Social Security at all. Anyways, they're already in a zero tax bracket. And when you're between those numbers of those ranges I gave, you pay 50% tax on your Social Security income. You pay a reduced rate and amount. So Social Security is already taxed less. Trump's campaign pledge was no tax on Social Security. Well, he couldn't deliver on that. So this was the compromise that was given to seniors, again, those 65 or older, is these additional deductions that will reduce taxable income. All right, now let's go through an example now. Hey, sorry to cut in here. I just want to make sure you know of my law firm, KQS Lawyers, where we help clients across the country save on taxes, protect their assets, and plan their estates. Get over to kqslawyers.com to learn more. We'd love to be of assistance to you. Now back to the video. Of someone making $100K a year, let's say 65 plus, married couple, both of them over age 65. I want to go through the additional deductions you already get when you're 65 and older that's already in the tax code, plus this new additional deduction on top of the additional deduction when you're 65 plus. So you can see how this really benefits taxpayers right now, those who are 65 plus. All right, so let's say you make $100K a year. Now for tax year 2025, the standard deduction is $30,000. Any married couple can take a standard deduction of $30,000. But for those that are 65 plus, in the example here, let's say it's a married couple, both over 65, you get an additional $1,600, in this case, $3,200 that you get to take as a deduction. That's already in the tax code now. So there's already an additional deduction for seniors of $1,600 per individual. Again, this is 2025 numbers. Now, what happens in the Senate bill is you get an additional $6,000 on top of this. So if we have two individuals here that are over 65, that's $12,000. What happens at the end of the day is all of this adds up. The 30K, the 3,200, the additional 12,000. If this new bill passes, you get up to a $45,200 deduction. So for someone making $100,000 a year, you are only going to have taxable income of $54,800. That's a significant additional standard deduction. In this example, it's $15,200 of a standard deduction, which you can think of that as you're not paying tax on $15,000 of income. That might be a little over $1,000 a month of Social Security payments that you might be giving if we're trying to tie this out to no tax on Social Security. So that's what's the benefit for those that are 65 plus right now. Now, the downside on the bill, at least for this new $6,000 per under the Senate, again, $4,000 per under the House bill, is this is only going to be for tax years 2025 to 2028. This is only for 4 additional tax years. After 2028, if this bill passes, this additional $6,000 under the Senate bill per person goes away. All right, we're going to go back to just the $1,600 per person for those that are 65 plus. Now, if you want to quantify the savings here, what I would estimate, let's say you're in a 20% federal tax bracket and you got the $12,000 deduction because the Senate bill passes and you're married, that would save you about $2,400 in taxes, because at a 20% tax bracket, if we take $12,000 off your taxable income, you're not paying tax then on that amount. That'll save you $2,400 again if this bill passes. So there is something that those seniors got, those 65 plus got. So no tax on Social Security would have been better. And frankly, to me, it makes no sense that Social Security is taxed anyways. You have to put this money into the Social Security system, and then you're getting it right back out and you have to pay tax on it. You got a crappy return from the federal government on your money. It's almost like a Roth IRA, but they're taxing you back on the way out. You got to put the money in, it gets invested. The Social Security Administration does a terrible job on it. You can do better in a Roth IRA, but then the money comes back out and you got to pay tax on it again. This is already the money you had to earn and put into the system. It doesn't make much sense, but that is the system we have. And actually, Social Security wasn't taxed when it was first created. It wasn't until 1980 that they actually started taxing Social Security, when they started building up the Social Security Trust Fund, because they realized benefits were going to run out if they didn't stop doing this. So they started taxing it back in 1980, sadly. So the road ahead, what we're looking at now is Social Security will still be taxed, but there is this new deduction for seniors 65 plus, again, $6,000 in the Senate bill, $4,000 in the House bill. And these are available even if you don't take the standard deduction. So if you itemize, you can still grab these additional $4,000 House or $6,000 Senate. Again, we'll see which one passes at the end of the day. All right, I want to just hit a couple other tips to keep in mind for those that are 65 plus, or as you're getting to that age. One is the standard deduction I already talked about, the additional $1,600 per individual that's over age 65. That's already in the tax code. And whether this bill passes or not, you'll be able to take advantage of that. Another one that's common is the qualified charitable distribution. This is where you can take money from your IRA and you might have a required minimum distribution on that. If you have a traditional IRA, you have to start pulling money out of that account every year. But when you hit age 70 and a half, you can do this qualified charitable distribution where you can send that money from your IRA directly to a charity. And we do this all the time at our company, Directed IRA, where clients have self-directed IRA accounts. Their IRAs can invest in real estate or other private assets. But at some point, you can take distributions either to live on or for charitable purposes. Now, when you take a qualifying charitable distribution from an IRA called a QCD, what happens is that does not go into your taxable income. See, when you typically pull money out of a traditional IRA, that goes into your taxable income. If it's a Roth IRA, it's not taxable, but this is for just traditional accounts here, that goes into your taxable income. And let's say you took $10,000 as a distribution, you're gonna have $10,000 of taxable income. But if that goes to a charity, then that satisfies your distribution rules. It is not included in your income. Now, you don't get to take a charitable deduction, but for those that take the standard deduction, maybe you're in retirement and now you don't have a lot of mortgage interest, you've paid off the home, and you're taking the standard deduction every year, like the example I gave earlier, making $100K a year, and you basically have $45,200 in deductions you get to take, and you're just taking the standard. You're not even itemizing. Now, you don't get to take a charitable deduction on here. Now, you have to itemize to take a charitable deduction. So this is a really good strategy if you take the standard deduction, because you can get the money out of your IRA. If you send it to a charity, you're already taking the standard deduction, so you're not losing out on the charitable deduction, but you didn't have to take that into income and then send it to a charity. So if you're being a little strategic about that, there's some ways you can use your retirement accounts. There's $17 trillion in IRAs. There's a lot of people relying on them in retirement. So that's a great strategy to keep in mind. Now, if you got confused there as I was talking about IRAs and what we do, where your IRA can invest in private assets like real estate and crypto and private funds, it's okay. Make sure you click the link below. We've got a lot of our detail and I got a lot of content on how to use what's called a self-directed IRA. Now, for tax planning strategies, no matter what bill passes or what the tax code is, my law firm does that every day for clients across the country at KQS Lawyers. Give us a call if we can help you, but you need to be proactive about your tax planning. You can't do your tax planning in April 15th for last year. You want to be proactive about that, be engaged on it to make sure you're only paying as much tax as you absolutely have to. Now, of course, we'll be tracking this bill, and please make sure you're subscribed to my channel. I'll be giving you updates on what passes here. Also, a lot of other tax strategies to protect your assets, grow and build wealth. I'm Matt Sorensen. We'll see you next time.